everyone, this is Rob Roy and welcome to this edition of the Elliott Options U.S. Market Update. A little bit of economic news to talk about today. We had the ISM Services report that came out. A little over 54 was the reading. It's up from 52 last month, and that's important because the services has been strong for a number of years now, and it was creeping back towards the important level of 50. In the reading, anything above 50 indicates growth, anything below 50 is contraction. So it basically gives you a gauge of the consumer. So if the services side is good, then in general terms, the consumer is still spending. So the market like that this morning. We didn't really make too big of a move today, but we're a little bit overbought in the charts. In fact, let's get to those charts and I'll show you what I mean. Okay, as we take a look at the SPY, I'm sure everyone, if you've been under a rock somewhere, knows that the market has moved to all-time highs. And remember the concept that we talked about in the past where felt like we needed to get the market to new all-time highs to get all that retail money that's been on the sidelines into the market, and then that gives the smart money guys somebody to sell to as they start to get themselves out before we get just a normal correction. Not trying to call for anything crazy or anything, but that's how the process normally works. We get the retail guys in, they come in last, they're the last ones, they're the ones that are going to be left holding the bag. That's how it always works, and it takes news driven events and headlines and things like that to get the retail public in. But I think we're starting to get there now. So where's the targets go? Well, let's go back and remember what we looked at way back in the beginning, which was this zigzag in this complex wave 5 that we have. So there was the initial move to the upside. As you can see here, there was our initial, that's our A wave in the zigzag pattern. So we label that with an A. And then we had the 61.8% correction level where we came down here. So that was the B level correction. And in the world of zigzags, the corrective pattern within Elliott wave, you're looking for, at that point in time, a 100% extension. So there's our B wave. So now we use the Fib extension tool. Really cool tools in this program called Profit Source from Hub. That's hubb.com if you're interested. And you can see that we've passed the 61.8% Fib extension, and that was right at the previous high back from July. And now we've moved up. Now, if we put the moving averages on, you can see that we're just a little bit overbought at this point in time. So it would make sense for the market to rest a little bit, maybe fill that gap, maybe even come down and fill this one too. But a little bit of back and filling would be warranted here before we make a run at that 100% extension. But once we get there, it's going to get very interesting to see if that's far enough to get the smart money to start to sell into a little bit, and we might see a little bit more volatility, a little higher volume in the market. Those are the signals that you're starting to get some of the smarter guys taking their profits and then getting out for a bit. So we'll see if we get some consolidation here before we make that run, but that's the eventual target. And the interesting thing here is I'm titling this one like Yin and Yang, Elliott Wave's version of Yin and Yang, where Yin and Yang is like a dualism concept where normally they're talking about how opposing forces can actually complement each other and create a balance in life. That's the general concept of Yin and Yang. What we have here is not necessarily that. It's more of the complementing and dualism thing where we have this zigzag pattern, this complex C wave within a complex wave 5. So they're similar there, and they're giving us both the same type of a reading as far as a move to the upside. I'd be very surprised if we don't hit that 100% Fib extension. The other side of the yin and yang that I wanted to show you has to do, and this is a little bit more along the concept, and this is interest rates. And interest rates are moving up, as you can see. Now, normally, equity markets don't like rising interest rates. That's one of the things that can quell a rally, is when you start to get interest rates moving higher. It makes it tougher to make money for businesses. It puts a squeeze on margins, etc. Tougher to borrow money for companies that regularly borrow capital. But In this case, we were getting to the point where rates were getting so low, there was the concern that these super low rates are starting to give us an idea that maybe the economy is weakening a bit, and that's not a good sign down the road. We had the inverted yield curve, which historically forecasts a recession 12 to 18 months down the road. So the fact that we've gotten a little bit of lift here in the rates, maybe it's just temporary. We'll see. It would like to see it move up to this to a 38% correction instead of this 22. That would be actually supportive of the market in the realm of, hey, maybe the economy is not weakening as much as we had been concerned about or had feared, and things are okay. Possibly avoiding that potential recession, but I hate it when people say, oh, it's different this time. That signal has been so strong. But again, it doesn't foretell a recession immediately. It's somewhere down the road. But the fact that rates are moving up is a positive thing. Take a look at the VIX real quick. This is a little bit of an area of concern as well for continued move to the upside, because we're at this supportive level down here around 12. We know, I've shown you this chart before, that we go back into 2017, we came down and the low was down around 9, and that was support. So just because we're down at 12 doesn't mean we can't break that level. It just hasn't broken it in quite a while. It's been acting as a pretty solid support. But that would kind of tie in, wouldn't it? If we got a little bit of a lift in volatility, maybe the market pulled back just a touch to fill those gaps. Maybe it takes off and runs right to that 100% extension. Then we would definitely be overbought and would look for more of a correction at that point in time. The next couple of weeks are going to be very interesting, and I'll be here to report them to you. As a reminder, if you like this, hit that like button, tell a friend. We appreciate it. Look forward to talking to you again next time. Take care, everybody.